This realm, often perceived as cryptic and daunting, is actually a treasure trove of insights. It holds the keys to successful trading, helping us make informed decisions about when to buy, sell, or hold. To navigate this landscape, we primarily rely on two compasses: fundamental and technical analysis. Fundamental analysis offers us a deep dive into a company's health and potential, while technical analysis equips us with tools to decode price movements and trends. But don't worry, we're not about to leave you stranded in this maze. Stick around to demystify these seemingly complex concepts. First off, let's untangle the web of fundamental analysis. It's a bit like being a detective, where you're sifting through a company's financial statements to uncover their true value. This detective work involves examining a company's earnings, revenue, assets, liabilities, and other financial aspects. But it doesn't stop there. You also need to factor in the industry conditions, economic outlook, and even the company's management. Think of it as looking at a company's health through a microscope. If a company's fundamentals are strong, it's like a well-oiled machine ready to perform in the long run. On the other hand, weak fundamentals could be a sign of trouble ahead. So fundamental analysis is crucial for investors who want to buy and hold stocks for the long term. It helps them gauge a company's health and potential, providing a solid foundation for their investment decisions. Now that we've unraveled the mystery of fundamental analysis, let's dive into the world of technical analysis. If fundamental analysis is the detective, then technical analysis is the fortune teller. It uses historical data, mainly price and volume, to predict future price movements. But don't mistake it for a crystal ball. It's more about identifying patterns and trends that can suggest what might happen next. Technical analysts use various tools and indicators to analyze these patterns. They look at things like moving averages, which smooth out price data to identify trends over time. They study candlestick patterns, which can indicate potential price reversals. And they use indicators like the Relative Strength Index, which gauges momentum and can suggest if a stock is overbought or oversold. In essence, technical analysis is all about spotting opportunities in price movements and trends. It's particularly popular among short-term traders who need to make quick decisions based on the latest market data. So, while fundamental analysis looks at a company's intrinsic value, technical analysis focuses on its price movements and trends. These two types of analysis serve as the backbone of any successful trading strategy. By understanding both, you can make informed decisions and navigate the stock market with greater confidence. Whether you're a long-term investor or a short-term trader, mastering fundamental and technical analysis is a crucial step in your stock market journey. Now onto the fascinating world of candlestick patterns and support and resistance. First off, let's demystify candlestick patterns. These are essentially visual representations of price movements within a given time period. Each candlestick is composed of 4 key points: the open, close, high, and low price. The body of the candlestick represents the range between the opening and closing prices, while the wicks or shadows indicate the high and low prices during that period. Now, why are these patterns so important? Well, they can reveal potential price movements. For instance, a bullish candlestick pattern may suggest that buyers are gaining control, possibly driving the price up. On the other hand, a bearish candlestick pattern may hint at sellers taking over, potentially pushing the price down. But remember, no pattern provides a guaranteed prediction. They merely offer probabilities based on historical patterns. So it's always wise to use them in conjunction with other analysis tools. Speaking of other tools, let's shift gears and talk about support and resistance. These are key levels where the stock price tends to change direction. Support is the price level where buying generally overcomes selling and pushes the price back up. Imagine it as a floor that prevents the price from falling further. On the flip side, resistance is the price level where selling typically overcomes buying and pushes the price back down. Think of it as a ceiling that prevents the price from rising further. Spotting these levels can be quite useful. They help traders anticipate possible price reversals and plan their trades accordingly. For instance, buying at support or selling at resistance can be a viable strategy when these levels hold. However, when these levels break, it could signal a change in the market sentiment. A break above resistance might suggest that the bulls are in control, possibly leading to higher prices. Conversely, a break below support could indicate that the bears are taking over. potentially leading to lower prices. Mastering these aspects of chart reading is crucial for anticipating price movements. So keep practicing, and in time, you'll develop a keen eye for these crucial market signals. Understanding trends is a powerful tool in your trading arsenal. In the world of trading and investing, spotting trends can be a game changer. Trends are like the wind at sea. They can carry your investment ship to your desired destination or steer you off course if not navigated properly. Let's unravel the importance of trends. Imagine you're a surfer, the waves are your market trends. Just as a surfer rides the wave, an investor rides the trend. If the trend is upward or bullish, it means the market sentiment is positive and prices are likely to rise. On the flip side, a downward or bearish trend indicates that market sentiment is negative and prices could decrease. Spotting these trends early can guide your investment decisions and potentially lead you to profitable trades. Now, how do we identify these trends? This is where trend lines come into play. A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. They act as a visual representation of support and resistance in any time frame. They show direction and speed of price and also describe patterns during periods of price contraction. Drawing trend lines may seem like an art, but it's actually quite straightforward. Start by identifying at least 2 highs or lows on the price chart. Then, connect these points using a straight line. The resulting line is your trend line. An upward trend line is drawn below the price, connecting the lows, and acts as a line of support. A downward trend line, on the other hand, is drawn above the price, connecting the highs, and acts as a line of resistance. Interpreting trend lines is equally important. If prices break above a downward trend line, it's a signal that the downward trend might be over, and an upward trend might be beginning. Similarly, if prices break below an upward trend line, it's a signal that the upward trend might be ending and a downward trend might be starting. By recognizing and understanding trends, you stand a better chance of making profitable trades. As we navigate the waves of the market, remember that understanding trends and using trend lines can be your compass, guiding you towards informed and successful trading decisions. Economic indicators are like the weather forecast for the stock market. Now let's delve a little deeper into the world of economic indicators. You see, the stock market doesn't exist in a vacuum. It's influenced by a multitude of macroeconomic factors, similar to how the weather affects the sea's tides. When the economy is booming, companies tend to perform well, leading to an upward trend in the stock market. Conversely, when the economy is in a downturn, companies may struggle, often causing the market to tumble. So what are some of these macroeconomic factors? They range from inflation rates, unemployment figures, and gross domestic product, GDP, to consumer confidence indexes and even geopolitical events. Each of these factors can sway the market in significant ways. For example, high inflation can erode purchasing power, potentially leading to lower corporate profits and a bearish market. On the other hand, a rise in GDP often signals economic growth, which can boost investor confidence and propel the market upwards. Now, onto the economic reports. These are essentially the tools traders use to monitor these macroeconomic factors. Key reports include the monthly employment report, the quarterly GDP report, and the consumer price index. By keeping a close eye on these reports, traders can glean insights into the economy's direction and make informed decisions about their investments. Keeping an eye on these indicators will help you gauge the market's overall health. After all, understanding the economic climate is a crucial part of navigating the stock market successfully. Let's apply what we've learned through a case study. Imagine if we were to analyze a recent trend in the tech industry. We'd first use fundamental analysis to evaluate the financial health and potential of various tech companies. This would involve examining key financial metrics such as earnings per share and price-to-earnings ratio. Next, we'd use technical analysis to study price movements and trends. We'd look at candlestick patterns to predict potential price movements and identify support and resistance levels that could impact the stock prices. As part of our analysis, we'd also consider economic indicators and key economic reports that could shape the tech market. These might include employment data, inflation rates, or even the impact of a global event. Based on this analysis, we could identify potential investment opportunities or risks. For instance, we might spot a promising tech startup or foresee a potential market downturn. By applying these principles, you can make more informed decisions in your trading journey. We've covered quite a bit today, so let's quickly recap. We've delved into the world of stock market analysis, exploring the integral role of fundamental and technical analysis. We've learned to read stock charts, identified market trends, and understood the impact of economic indicators. Remember, this knowledge is not just for understanding, but for application in your investment journey. Thank you for joining us today. We encourage you to share your thoughts and questions. Stay tuned for more insightful videos on trading and investment. I'll see you in the next video.